I would like to call upon Dr. Bitange Ndemo, who is the main guy behind this Entrepreneurship Forum, so that he can introduce us to what's going to be happening today. And in case it's your first time at the iHub, feel free to find either me or even Brian and Martin around here. We can, tell you what usually happens here at the iHub later, maybe at around 1. So let's welcome Dr. Ndemo.
Good morning. This is our 4th entrepreneurship lecture series. We have covered a number of topics in the past 3. Today we have 2 speakers. The main speaker is going to be Paul Muthaura, who is the CEO of the Capital Markets Authority, to speak about the Real Estate Investment Trust. But before he comes to speak, I have a friend, Muthaura, who has been working with SMEs, financing SMEs across Africa. They have spent more than $13 million in financing SMEs. And I thought it would be important that we begin to address the various aspects of entrepreneurship. We have covered several areas. We covered technology, we covered business development services, we are covering the financing. We are also looking at how we can get the young people into the real estate through the Real Estate Investment Trust. But some of you have been coming independently, asking for help. This coming semester, the previous semesters, we've been working with few of you in developing business plans. And the way it's been working is that I get a few of my students to work with you and develop the business plan for you. So this, from 9th September, I get a group of new master's students, which I would be able to give as a class project to work with you and develop your business plan. That way, you go through the rigors of creating better business plan and talking to financing people and talking to business development. We can actually be able to help and find solutions to sustainable entrepreneurship development in our country. So without going too far, this offer, you can talk to me, you can write to me, then I can assign you. I actually need a lot more people this time because the class I'm going to have is much bigger. So I need every student to get into this project to do the business planning. I've seen the tweets, people asking what has been the impact of this lecture. Actually, there has been an impact. We probably provide a report in the next entrepreneurship lecture series when we meet. So without going too far, I want to welcome Muthaura to speak to us briefly, then a few questions before we can ask Paul to come and speak. Thank you.
Thank you everybody for coming. My name is Muthaura and I work with IDEV International. IDEV is a financial advisory and management strategy consulting firm. As Dr. Ndemo said, we work with SMEs in emerging markets. So we've worked all across Africa, and also we have an office in Lima, Peru, where we work in South America, and a corporate headquarters in San Francisco. And we work with businesses both pre and post-investment stage. And we help them to scale. We help them look for opportunities to develop their supply chain, develop their distribution networks. And if they are ready to access financing, we can help be their advocate and look for solutions that make sense for their business. So what we're going to talk about now, very briefly, is investor readiness. How do you know as an entrepreneur that you are ready to seek capital, and what considerations will be unique to your situation? So some primary things that you need to evaluate about your business are its general uniqueness. You need to look at your place in the market and what value proposition you're going to offer investors. Investors need to get something out of the deal as well. Another key point is barriers to entry. If your business begins to see success, what's stopping other copycats from just joining the fray? Also scalability. How can you grow your business? How can you realize economies of scale as you get larger and increase your margins? And then stage. Are you a seed stage company? Are you growth stage? Are you pre-revenue? Are you post-revenue? These are all important considerations. And then when you're thinking about what type of capital you want to take on, you need to consider, if you're going to take on debt, for instance, do you have the ability, the cash flow to make interest payments? If you're gonna sell an equity stake in your firm to an investor, you need to consider, what stake of your business are you willing to give away? And then also the legal structure. If some of you are entrepreneurs running nonprofits, you may not be able to pursue certain options. Again, we talked about stages as an important consideration. This graph right here lays out the different stages: seed, startup, initial growth, and expansion. And this is the general risk level that's associated with these businesses. And then here in the plot area, we see all the different types of financing that are typically available to businesses at those levels of risk and stage. So I won't say too much about this, but you can observe what's there. And another thing I want to make you guys aware of, I'm not sure if you'll all be aware of the impact investing industry, but for some of your businesses that may have a social impact or an environmental impact, you may be able to access a special group of investors that are impact investors. And what defines impact investors? They, in addition to seeking financial returns, will also seek social or environmental returns. And because they have this social-driven mission, they are often willing to offer lower interest rates and longer payback periods. So generally more favorable terms because you are contributing something positive to society as a business. This is in contrast to more commercially oriented investors who are purely going to seek financial returns. They're going to be more risk averse than impact investors, and they'll generally avoid companies without a credit history or collateral. So after you've figured out which class of investors is appropriate for you to approach, you need to consider how you would structure an investment. There are a number of different ways you can do this. You can take on grant capital. Grant money is essentially free money, often no strings attached. Equity, you have to be willing to part with a piece of your business. And that's often a difficult thing for entrepreneurs to consider, giving away something that they've started. Debt, on the other hand, you get to maintain ownership of your business, but it's going to be a draw on your cash flow as you look to make interest payments. And then hybrid is a class that's somewhere in between debt and equity. So like convertible debt, for instance, would be an instrument where you're paying interest, but the investor might have the option to convert that debt into common equity shares. So you have to consider what is really appropriate for your unique situation and what stage business you currently are. And then finally, once you've decided how you're going to structure your investment, what class of investors you're going to approach, you need to think about preparing to make that approach. So things that you really need to get together are a business plan and financials, preferably audited, but not everybody has the capacity to produce those. You need to come up with realistic projections about where you think you can be in the next 5 years. They can be ambitious, but they need to be within the realm of possibility, because investors, it's their job to tear these projections apart, and they're really going to look into what you put together. Also, if you're buying and selling a product, formal supplier or buyer contracts to demonstrate that you do have commitment from people to purchase your product, and you do have some security in terms of your supply chain. You're mitigating supply risk. Also, if you're going to approach impact investors, it's good to have some sort of evidence of the social impact of your business, and this could come in many different forms. But all of those things are going to be generally valuable if you're able to prepare those in advance of approaching an investor. And once you have those together, you also need to consider who you're going to approach by factoring in their preferences for geography. Do they invest in businesses in East Africa? Their sector, do they focus on tech businesses? Do they focus on agro-processing? What stage you're at? Investment size, how much capital do you need? How much capital can you really utilize and absorb efficiently? and also the expected return. So these are all important things that you need to consider. And that's the end of this brief presentation on investor readiness. But I'm happy to talk to you about any more detailed questions that you guys might have.
Any questions, Matt? Questions? Yes, sir.
So you talked about grants and the issue of it. First of all, thank you for the presentations. Thanks for the presentation, Matt. So I just had a question about grants. You talked about being money that is given for free, but there are types of grants that are called convertible grants, where there's the option of converting it into a common equity share.
Yes.
So what is your perspective on that?
I mean, that can be a good solution for your business potentially, but it really depends on your unique circumstances. Obviously, free money, no strings attached is better than a potentially convertible grant, but the investor might be able to make a larger grant if they have that option of converting. It's basically it's a favorable term for the investor, but they might be able to offer the entrepreneur something favorable in return. Makes sense. Any other questions?
This one, yeah.
You'll be invested in business in East Africa. What profile of businesses are you invested in?
So we are actually not the primary investors. We are financial advisors for small and medium-sized companies that are approaching investors. So it's our responsibility to work with entrepreneurs as their advocates and help them negotiate favorable terms with investors. Because a lot of times that's very difficult for an entrepreneur who's really focused on building their business up and building capacity to be able to run their business and run this fundraising effort is a difficult thing. So we work with them to help them make that process smooth.
What profile of business have the investors shown interest in sectors of the economy or business at what stage of development?
There's a lot of interest across the board. There are different classes of investors that you need to approach, and that chart that was up there earlier that showed the stage of businesses and which type of investor would be appropriate given your particular stage of something. I can share that with you later. But yeah, there's no matter what stage you're at, you have access. Very early stage, you can approach people who are seed investors or angel investors. And then later stage, you get into more traditional private equity or venture capital firms once you're post-revenue and you have the ability to scale. But we've personally, IDEV has worked with businesses raising anywhere from $500,000 to $24 million. So in between that range. And then industry agnostic. We do work with a lot of businesses in the agricultural industry just because it's very important to the economy here. But we also like to work with companies doing unique things in tech and manufacturing as well.
Yes.
So I was wondering, how do you check the resources? You come to start trying to consult with investment. How would you charge? Would you go through equity or
That's a good question. So, if we're doing a fundraise for a company, we will usually have it be a back-ended fee. So a portion of the capital that is raised will pay for our services. So a lot of times it's no money up front. But because of that, we have to limit our risk and get involved with businesses that we believe are going to be able to achieve success in their capital raise.
In the slide about the funding available for startups or for businesses at different stages, there's mention of DFIs. Could you expound on that?
Yeah, so DFIs, development financing institutions like USAID or DFID, are funding a lot of different projects, sometimes through intermediaries in emerging markets. So there's a lot of opportunity to, even at the seed stage, access that financing.
I have a question on social enterprise. What are the basic components that investors ask for or looking for investment?
So for a social enterprise, what are investors looking for? Well,
It must have a social impact.
yeah, it's good to be able to quantify your social impact in terms of maybe households impacted or local income boosted by X amount or some sort of figure that you can put to it and provide proof. That's very positive to be able to show an investor who's interested in investing in socially impactful businesses.
With the kind of stages you're laying out with what you need to do in preparation, how important do you see issues around governance structures and transparency in being able to attract investors, especially these early stage entities? How important is the whole governance structure of the business, their boards, independence, or is it not so significant?
With the stages of business that I mentioned, obviously with the smaller you get, the investors who are going to be looking to put money into these social enterprises, they're generally aware of the capacity of these businesses and their internal, corporate governance and all of their financials and everything. They know that there is going to be some level of work put in to get all of those things to be perfect. And they're willing to work with companies basically that don't have all of their ducks in a row necessarily to get things up to speed. But obviously, the larger ticket size of investment that you're looking at, the company needs to show professionalism and transparency and solid corporate governance. Earlier stage, it's a little bit easier.
We have a constitutional requirement. There have been a number of men asking questions. We are in a crisis. Oh yes, thank you.
Okay, a lot of times women are very reluctant to get into business. And so is there special funding for women seeking to get into business? Yeah, you advise that.
Yeah, there is. And there's actually a lot going on in that area currently to earmark special funds to specifically invest in women. And yeah, we work with women and we can talk more. Definitely.
One last. Thank you.
Thanks, everybody.
Thank you. Matt will stick around, and if you have a question or you want to know details on how they can work with you, you can see him. And he's going to leave his contact so that once you decide, you could come later and go see them. They're just here in Wadiakid. So, now, we want to welcome our chief guest, Paul Muthaura, who is the CEO of the Capital Markets Authority. And he's been wanting to see younger people get into the real estate investment trust. And we said, let's unpack it to understand how we can get into this real estate investment trust. It is getting ready. After Paul speaks, someone We have someone who would speak to us later. I will introduce him. But as they are working on this, our sponsors, Chase Bank, if someone can come and make a commercial, Chase Bank. Who just Olympia what? They are our sponsors, and we have to remember our sponsors every time.
I'm from Chase Bank. I'm Ronald Bishuki from the University Department. And the reason we, perhaps I'd say, we started sponsoring these kind of talks is to actually, as our purpose statement says, help people achieve what matters to them most. And if you're here today, I'm sure then this is a big part of your life. As entrepreneurs, I'm sure this matters to you a lot. And our goal as Chase Bank is actually to help you achieve what matters to you most. So if these talks are helping, you can tell Daktari these things are actually helping. If they're not, Daktari, you can ask maybe these things are not helping us. No. But I think they are, and I have seen the crowd growing on a monthly basis. So I'd like to thank you all for coming and attending. And I'd also like to thank Daktari and all the speakers that have been there, even previously, the past months. I'd like to say asante sana. So from Chase Bank, we thank you all for even making that effort. Thank you. Oh, yes. Well, listen, I thought that would be introduced. These are the guys from Chase Bank. If you want to open an account, if you want to know any things in terms of financial advice, if there's something that you want to inquire, if you want a loan, these are the guys to see. So please, feel free, yeah? So, thanks.
As you can see, finance is not a problem at all. We have Matt there, we have Chase Bank here, we have Paul to simplify things for us in the real estate. Now, Paul, karibu tumpigie makofi.
Morning, everyone. Now, I've been given a narrow brief by Daktari to really give you a bit of awareness about the space of real estate investment trusts and what you can do to more actively participate in the real estate boom that's going on in the country. But I have taken the liberty to slightly expand my mandate, and I hope I'll be forgiven for that. But just to give you a bit of context, you're all hearing so much about the vision. There's, be it single gauge railways, the lapse at port, you're seeing the massive road infrastructure coming in place, and there doesn't seem to be any challenge for the internationals to get involved, to really significantly invest in these projects. But I think there is a growing potential that Kenya could wake up in 2020, 2022 and see a fantastically transformed country, but Kenyans themselves are wondering, where's my piece of this? I'm seeing all this massive wealth creation in the country, but I am not feeling particularly different. Yes, my road infrastructure is better, the IT infrastructure is better, there are more opportunities for jobs and job creation, to some degree more opportunities for entrepreneurship, but I don't feel like I own my piece of the nation anymore. So I want to give you a bit of sensitization as to what can we do, what are the instruments, what are the products that are available to make sure each and every one of us have an opportunity to participate in the transformation of the country, and give you context on what are the different things you need to take into account as you look at those different kinds of products. Now, a lot is said about the capital markets, and unfortunately half the time it's really presented as the greatest casino on earth. You will throw money at it, maybe you will make fantastic returns, maybe you will lose it all. And there's very little contextualization of, okay, what is the real role of these capital markets? What is their real impact in your life? Now, first and foremost, capital markets are about really channeling capital into long-term investment. You have the banks, Chase are here, fantastic to have them, but when you look at the reality of the cost of bank financing and even the capital and reporting requirements that exist on banks, banks are looking at months to maybe 3 to 4 year window on the kind of money they're lending you because they have capital requirements. So they're not looking at how do I give you money for 30 years. If you look at the reality of the mortgage sector in our country, houses are coming up every day, but how many people actually have mortgages? How many people can actually absorb the cost of mortgage financing when you're still seeing it at high double digits, high to middle, 12, 13, we're supposed to get very excited when someone offers you a mortgage at 12%. They market it as a sale, but globally, mortgages are going at 3 to 4%. That's what you can afford. How many companies themselves can afford the cost of a 12 to 13% per year charge on what they've borrowed? Very few companies make that to cover their expenses, plus profit, plus debt management. So that's where the capital markets really come in, to look at how to provide much more affordable, long-term capital to help companies grow, to help businesses diversify, and really to have an impact on the economy. Now, more for the purposes of the discussion we're having here, it's also the role that the capital markets play in diversifying ownership. That you can see, if you look at the transformational impact that listing has on a number of companies. Equity Bank, for example, much is said about they're projecting 10% per year growth as it stands. And that is only since they became listed. Because, one, you have a much more diversified shareholder base. You have the ability to raise much scalable amounts of money. When you're negotiating with a bank, they look at you, they wonder what kind of collateral you have, and give you a very hard push on how much money they're able to make available. But with the kind of diversification of risk you get with getting money from 10,000, 100,000, 200,000 people, their individual risk is much lower. So what they'll demand of you is, by reflection, much lower. One bank knows you as one risk. If that is spread out over thousands of people, they demand much less return from you. And that's where the real opportunities come from. And also in the kind of value that will come from governance and transparency. As long as you're a small company being run by the 4 members of your family, the kinds of decisions you make will really be limited by the minds of your small family. But if you're able to bring in new people, new thinking, new thoughts, new expertise, the exponential potential growth for your company is once again true. Now, this is just a simple reflection of actually what Matt was showing on the different stages of growth, but now this is at an economic level. Where does money come from at the different levels of growth in a country? When a country is at its lowest levels of development, you'll find most projects are able to be driven by government. Government will find money somewhere in the budget to start something. But as the company grows, as the country grows, you'll start needing to leverage commercial banks to provide that funding to diversify the liability of government. But ultimately, when you're looking at the most developed nations, that funding can only come from the capital markets, the private sector. Because if you compare, Kenya right now, loose figures, 80% of national funding comes through commercial banks, 20% through capital markets. In the US, it's the exact opposite. 80% comes from the capital markets, 20% comes from banking. Because your ability to drive economic growth on the balance sheet of 1 or 2 commercial banks is very difficult. But if you're able to open it up to global balance sheets, now you're dealing with a Kenyan, everyone in East Africa, everyone in Europe, everyone in the US, the scale of capital that's able to be raised significantly increases, and therefore you start being able to drive much more accelerated economic development. Now, you may wonder in your minds, capital markets. Really, what are capital markets done for us in this country? We hear about it, we hear about the NSE, we hear about a few companies on the NSE who seem to be making, I think the press have been very effective. And every few months they publish photos of the billionaires created by the exchange. But what has it really done for the country? In the last 8 years, the capital markets have raised 2.4 trillion shillings. Now, Daktari, I know when you look at the kinds of budgets we have for vision projects, 2.4 trillion would deliver the gross majority of our vision, but we're not effectively tapping the markets to drive this. The gross majority of this figure is being raised by government through debt for purposes of more operational running expenses. Oh, there's a strike by teachers. Government goes into the markets to raise money and not really using the money for long-term investment that is performing. When you look at, a lot is said when you look at international markets. In 2007, 2008, there was a global financial crisis and the markets melted down. In the US, in Europe, all their markets just came to a grinding halt. But in that same period, since the crisis, over 800 billion shillings has been raised in Kenya, which shows us that as an emerging economy, one of, as it were, almost the benefits of not being that interconnected with the global financial markets meant that we've not been as negatively impacted by that crisis. So while they're seeing a slowdown, we're seeing phenomenal growth. If you look at interest rates in the US being down in some situations even below 1%. In Kenya, you have the exchange which is returning a 49% return in just 2013. So there's phenomenal growth going on in the country, and we need to make sure we're all able to jump on that and leverage that and participate in that growth. This is just a reflection of where these marks coming from. And as I showed you, but out of the 2.4 trillion, more than 2 trillion of that is coming through debt, and that debt, gross majority of it is government. Right now, the debt markets in the country, about 95% government. There's increasing corporate borrowing, but we need to drive that because it's the private sector who's, once they're able to leverage the markets, they'll be able to drive genuine economic development, grow, and create entrepreneurial opportunities within the economy. We have seen a very significant slowdown in IPOs. 2014, as it is now, this was April, apologies, we've had one, the exchange, which is also a testament to the fact that the exchange itself is recognizing that you cannot encourage others to list if you as an entity are not putting yourself up to that same standard. If you're not going to commit to the same level of transparency, governance, reporting that you're asking others to commit to, it doesn't create confidence in you. So we see it as a very significant step, that the exchange has gone through demutualization, is currently going through an IPO. Out of interest, how many of you participated in the NSE IPO? By show of hands. One. When you look at the NSE is the number 3, as at the end of 2013, was the number 3 performing exchange in the world. The number 1 performing exchange on the continent. And there was an opportunity for Kenyans to buy in at 9 shillings 50 per share. Only one person in this room, and you're the future, participated in that. Those are the things we need to really critically think about. What are we doing to empower ourselves? To make sure that we will be the next ones benefiting from the growth and transformation of this country. It's that ownership. Share ownership is about taking a piece of the potential profit as well as future risk of an entity. And we need to transform our minds. In the last year, how many of you have invested in a piece of land? A plot. I will see a lot more hands. Now, that same piece of land, how many of you actually have to make that land give you a return? Or is it just sitting there in the hopes that it will do something for you one day? Okay, so, and I think that's the challenge, that many people are seeing land as a speculative investment. Let me buy some land, put it there, then one day I will flip it and get some money. Part of what I'll be presenting on is how do we now start using the markets to generate money so we can start developing the land. The land starts paying you rather than just sitting there in the hope that one day it will give me something back. Now, the first area I want to touch on, and this is, as it were, the wider spectrum of what a real estate investment trust is. A real estate investment trust is just a property-related collective investment scheme. It is a subset of a much larger pool of potential assets. Now, CISs, collective investment schemes, they exist, one, to ensure that there's diversification. As you know, what money you get, your ability to invest in multiple assets is a function of how much money you have. If you have 50,000, 100,000, you are not going to, for example, invest in 20 of the companies in Kenya because your incremental investment will be too small to get a benefit. But if you take that same money and put it into a CIS, you are now a pool of 300-400 million, a billion. Now that money can be spread much wider and therefore your risk diversification is improved, your exposure to different asset classes is improved. Two, liquidity. And it comes back to that same land issue. When you decide, okay, I need to see how I can realize or get back some of my money, the time it takes to sell a piece of land, the challenges that you can go through in that are non-existent when you're dealing with the CIS. You have a fund manager who today you say, I need the money, you go, I want to sell my units. Instantly, you're able to cash your value. When the markets have grown, you say, okay, I invested when the unit trust was, let's say, my unit value was 10 shillings, now my unit value is 15 shillings. That's a 50% growth. Let me get my money out. You can instantly do that, which for very many asset classes you're not able to do. Next is professional management. We all have our little money. Unfortunately, many of us invest where we hear people are investing. I hear land in this area is good, so you run to buy it. But by the time you part, you're probably the one they are selling to make their profit. You're behind the curve. Or even your ability to decide when is the right time to invest. I hear the market is doing well now. Is this the right time to sell? Should I sell tomorrow? By involving yourself in professional management, you get to address that gap. You have people who have no responsibility other than the whole day, all they're looking at is how best to make you money. Because they're investing their own money. So the more they make, the more you make. And you're not trying to read the papers to understand. You may maybe hear programming. While you're doing that, how much time do you have to really track the trends in the market, track all the news to know where it's going? Professional management allows you to really benefit from that. Risk appetite, it is about looking at the different products that are available and saying what appeals to me. Is the money I'm putting aside maybe money I want to invest in school fees, or maybe I have a very clear cost 1 year from now. So I know I need, if it was 10,000 bob, I know I need the 10,000 bob back. If I make more money on top of it, the better, but I must have that back. So you choose a product that is guaranteeing you principal and has given you a bit of room for growth. If you're saying this money I have is, one of my businesses paid off, I've landed on a bit of money, and I want to take risk with it. You can invest in a much higher risk pool of assets where you have much stronger potential for growth, so much stronger potential for loss, but you're willing to take that risk. So you need to understand, one, what you're looking for in your investment, and then engage with the professionals to help you identify where should my money go to make sure that's achieved. Next is tax benefits. A lot of effort is being put in place by government to try and encourage you to save. One of the things I'll show you later is there's a very significant disconnect between our level of growth as our country and our savings level. We're a very consumption-oriented country. And as long as you're not saving, there's very little to put into future growth, development, and transformation. And government is really trying to encourage you. So if you put your money into a CIS, your return will be tax-free. How many investments do you have legitimate? I think it's important. Will you be able to invest it that will give you a tax-free return? You need to take advantage of these things. Spreading the risk, once again, as I was saying with diversification, it really helps you to not have your money in one pot. And when that one doesn't go well, you're at a loss. Because your risk is spread across different classes, different issuers, different types of risk. When one is doing badly, one is going up. You know, if you hear about mixed collective investment schemes, where it has a bit of equity, a bit of debt, because those are inversely linked products. When interest rates go up, your return from debt goes up. But because debt's going up, your cost of investment and all those other things becomes very expensive, so equity returns go down. So if you have a mixed fund, when one goes down, you get to ride the other one up. When the other one comes up, you get to ride the other one down. But if you're only locked into one or the other, you don't have the same level of flexibility to flow with transitions in the economy. Now, narrowing it down a bit more to how can CISs really play a role in just the opportunity to own a part of the country, own a part of our transformation. Now, as I mentioned, CISs are about really lowering the point of access so that if you want to invest in the pipeline going from Lamu to Juba, you as an individual do not have a couple of 100 billion shillings lying around. You do have 100,000 that you've been able to put together. Through a collective investment, you can buy a piece of that action, so that as that pipeline starts performing, you start getting a return, rather than sitting and feeling you're locked out from being able to participate. You know, we see CISs as also providing an opportunity to allow local communities to take a piece of participation in emerging projects. If you look at, for example, Talo in Turkana, right now, there are very few people in Turkana who are able to walk into Talo's office and say, by the way, here is my $50 billion. I want a piece of your action. I want to make sure that once this oil starts flowing, I, as a member of this community, will start making money. But if you're able to structure the investment as a collective investment, so that the community has an entitlement to, 10 units, 50 units, 100 units in Talo as it grows, so that even if they don't have the cash today, they have an entitlement to participate in that unit locked in from day one. So that when they start getting their revenue allocations from that oil, they're able to put it into ownership. So that the fight is no longer about have you employed people from our community. Because our community is vested, they're owners in the growth and development of these projects. That is what's going to drive transformation in our country. Much the same, you look at, in many countries, especially where there's oil, you have a very small group of people who are making all the money, which breeds a lot of national instability. Through CIS-type instruments, you get to create opportunities for a wider spectrum of the population to have an ownership stake in these projects, to feel that it is better, let me not block the road to that oil pipeline. Let me not stand in the way of the settlement of land transactions for a mining project, because I own a piece of it. The more I facilitate it, the more I will benefit in the long run. That is what's going to make sure that Kenyans as a people have enjoyed the value of the growth and transformation of our country. Because it must be said, the vision is going to happen. It is, are you a part of it? If you look at what's going on in this country, there is no doubt the vision will be delivered well before 2030. But you have to make sure you're a part of it. You have to make sure you're participating in the value that's going to be transformed and delivered from that. On this point on unit allocations, for example, if a community today has no money, but there's an oil pipeline, there's a coal mining that's going to happen. They'll say we don't have cash today, but we want to be allocated X amount of units as part of the settlement with us. Don't give us cash, because cash will be expended within the next year, 2 years. Give us true value ownership in the long-term growth of the company. When you start producing, and when you start, in line with the Constitution, giving a piece of the return back to the surrounding community. That return, instead of coming out as cash, goes into investing those units, those shares in the community. So that 5 years from now, when oil is flowing, you already own 5% of the company as a community. And that ownership will not change. The more oil is produced, the more money you get out. So that you keep growing and transforming everything. Now, I think I've covered this point. Now, what you all came here hopefully to hear about is now real estate investment trusts. How are these, as a subsector of collective investment schemes, going to help us? Now, first and foremost, I think it's important to clarify that rates are not about, rates are really a structure on how you make sure that you're able to raise scale amounts of money for investment in real estate. As an individual saying, today I want to set up a rate because I want to build my house. Now, strictly speaking, your ability to raise the money for your house, to raise 10 million, there are many ways to raise 10 million. And the kind of structures you need to put in place, as I'll explain to you, putting in place professionals, having valuers, having property managers, the cost of the structure may exceed the value. But if you get together and you say, let's try and see how can we build an estate. We clearly don't have the money to build an estate. But if we're able to build multiple units, we can package a deal that will, one, need more money to go in, but also deliver much more money coming out. That larger structure has enough room to cover the costs of the structure, to put in place a professional fund manager, to have a trustee, a custodian who will make sure that anyone who you say, please give me money, they don't worry about you. They're not looking at you as an individual to see whether they trust you. There's a scope of professionals who they know are licensed to oversee, who are going to ensure that whatever money they put in will be properly managed, will be allocated, and returns will be delivered to them as registered owners and not chasing an individual. That also removes that personalization. That is still one of the biggest challenges. People are raising money because of who they are, not about what they're able to do. Once we're able to start packaging projects, it's the project that's going to deliver value. It'll attract investment. Who you are, neither here nor there. Once again, we start dealing with scale and growth and deliverability. Now, for Kenya, we took a slightly different course. The rest of the world has what are known as income roots. That is, you have all these existing buildings, be they malls, hospitals, apartments, student housing, that all develop. They're already generating revenue. So what you're doing with the rate is taking them all, putting them into a single larger pool, and allowing the rental income to be the one that pays the return to the people who invested in you to put this larger pool together. But in reality, in as much as we see all these buildings coming up across Kenya, we still don't have nearly enough real estate infrastructure in the country. So we came up with what's known as a development route, so that you're able to pool money for construction and development ab initio, so that you're able to create that critical mass of properties available to be flipped and sold into now income generating REITs. So you create this a positive cycle or recycling mechanism for money. That you go, identify project, clear scalable project, clear revenues, you're able to raise the money from the public, that allows you to construct it. Once it's constructed, you have very clear projections on its revenue potential. You already have a number of leases locked in. You can then sell it into an income generating REIT because the income is guaranteed. That starts, and you're able to recover money, pay your investors, and raise the next batch of money. You're not trying to negotiate with the bank over how am I going to repay you this money over the next 10, 15, 20, 30 years. Because you now have a positive circulation process for that money. That is what we see as the transformational impact of REITs. it is not that we are not advocating for the empowerment of individuals to build their own property. But if we keep funding our person to build our house, we will be a middle income country in the year 3020. We need to start looking at scale. How do we build a lot in the most constructive, proactive manner? If you're buying tiles for a house, you're buying tiles for 10,000 houses, what's your unit cost differential? That is where we're able to collect larger amounts of money, drive down costs, drive efficiency, drive implementation. That's where we see rates really delivering an opportunity. As individuals, you can be investors in rates. Even in the most developed economies, you have maybe, for example, Malaysia has 20 REITs. Australia has, I think, about 200 REITs. These are multi-trillion-dollar pools amount of money. You don't need many structures, but everyone can invest in it. So we're not trying to have a multiplicity of rate instruments operating in the country. We want to have a few that are clear, well-structured, that everyone can confidently say, I'm going to put my money there because it has a large enough portfolio that I know what kind of return I'm going to get, and I have the confidence that that return will come. Now, what are REITs being used for? The world is creative, and I think Kenyans are some of the most creative people in this world. But elsewhere, they have been very traditionally office, hotels, residences, apartments, factories, warehouses. Those are all very cut and dry, very clear. Build it, they will come, they will generate rent, you can flip it, you can move on. But then now, when you look at the challenges we're having right now in parking in Nairobi, car parks. If you have, a parking lot is one of the most simple constructions you can ever build. A few pillars, a couple of floors, and then paint it. Yeah, exactly. Your infrastructure that you need to put into a parking lot is almost non-existent. But each of those slots painted on the cement is going to deliver 350 shillings per day to you. If you put, let's say, a 7-story parking lot at Aga Khan Walk, maybe the one on the other side of the insurance plaza, and outside the High Court, every car in Nairobi will have a parking lot without any problem, in just 3 slots. But now we're trying to place cars next to each other and thinking it's going to build revenue. Build upwards. If anything, we've gotten confused with the fact that we have a lot of land. We're not using it efficiently. Many of the parking lots in Nairobi should be buildings, should be doing other things. Concentrate, build upwards, drive revenue. Parking lots, I think, is the easiest. Don't even look at, housing units. Oh, I'll build an estate in Karen at 80 million shillings per house. It's a lot of work. You have to do finishings. You have to get clearances for change of user. You have to import your tiles from Italy, so people feel the reason they're investing 80 million in your house. Go have a parking lot, and you'll see how much money you make. Even, for example, in Malaysia, plantations. Malaysia is the largest palm oil producer in the world. So they've structured rates to put out plantations for palm oil. So there are a lot of ways you can push and pull these products to make them deliver the needs that are relevant to the country. We know where our gaps are, and we're trying as an industry to provide you with responses that are products that are going to be able to respond to our national needs. Now, this is the point I was making about the structure that's necessary for a REIT. This is the most basic, low risk. You're investing, let's say, you're building a REIT to buy the Junction, Sarit, maybe Thika Road Mall, and Galleria. They're all fully rented, making good returns, very low risk investment. But at a minimum, you must have a trustee. This is a licensed person whose sole responsibility is to make sure that whatever revenues are being received are being properly allocated. And they all properties are registered in their name. So you know, if I have any question, I go to my trustee and ask them, where's my money? You have a personal liability as a trustee to give me to account for where the funds are going. That's the safekeeping. Then you have a rate manager. This is the person who does nothing all day but look at the property, figure out maybe if I adjusted the partition like this, the revenue potential of this building will go up. Maybe if we change the parking like this, the revenue potential could go up. If we change our tenant mix in the mall, maybe we need to start dealing with this kind of service provider rather than that. The revenue potential for the building can go up. They're the ones who really, what's called stress the asset. Find a way to make it pay the most, and that's their sole job. They're not taking care of your money. The trustees taking care of your money. They are taking care of the operating potential of your investment. Then you have the properties, which is what all of these are investing in, and then the rate itself is just a tax-efficient structure to bring all these people together. The rate is created, it's overseen by the trustee, it's managed by the rate manager, it is inspired or brought by a promoter, and they're the ones who issue the units to you. But the rate itself it has maybe an employee, it has a board, but they are not an operating entity. They are just a pooling vehicle. So that you have a central point that can collect in properties, issue securities, collecting money, return it to the trustee, make sure the rate manager pays you. So we need to look at these things from the perspective of what is their role, what is their efficiency. Keeps the money flowing, keeps the liabilities and responsibilities clear, and it makes sure that you get what you expect out of the process. Now, moving on from rates is what are these other instruments we can use to make sure we're participating. When you're looking at large-scale infrastructure, because of the risk, the revenue potential of large-scale infrastructure, it lends itself very well to debt financing. But there are many different kinds of debt financing you can have. You can have, your average corporate bond where a company is, look at my balance sheet, this is how I'm performing, this is how much I've been able to make over the last 5 years. If you lend me money for the next 5 years, you can see how my business will grow, I'll be able to pay you back. That's very clear and very balance sheet focused borrowing. Then you have convertible bonds, which I think Matt made reference to. That you're telling someone, because I think it's important to clarify, bonds. Demonstrating the key difference between bonds and equity. Equity, you're an owner. If things are good, you enjoy. If things are bad, you suffer. Debt, you're a fixed income owner. No matter what happens, good or bad, you will pay me X, period. Now, because of the lower risk involved in debt, the returns in debt generally are low. Because it's guaranteed. It's a fixed income security. Every month, every 6 months, every year, I will get a check for X amount, and at the end of the time, I will get my principal back. Very cut and dry. But if you, for example, in 2003, Safaricom issued a 4 billion bond instrument. Safaricom was not Safaricom in 2003. It was growing, it had potential, Kenyans were taking up mobile phones, it looked like there's hope. Now, that was a 10-year, it's a 7-year debt instrument. So you are guaranteed, if you put in $1 million, you get your, let's say, 12% return every year, and then at the end of it, you get your £1,000,000 back. Now, if you are an equity investor in Safari, and you gave them £1,000,000 in 2003, how much do you think you'd be getting out in 2011? When it's delivering 23 billion in profits. You are an owner of that. That's the critical difference we need to make in our minds. That they have very different risk profiles, they have very different purposes. Now, convertible debt finds that middle ground. It says, when you're in early stages, I want to give you money and I want you to commit to pay me back. No questions asked. But at some point, I want to have the option, when things start looking good, to become an owner, so that I can start enjoying that revenue. The trade-off you get is, if you have the potential to become an owner one day, you can't ask me for 13% return today on your fixed income. I'll pay you 6%. Because you can't have that higher commitment of return if there's a potential to turn it into something else. So it also helps a company lower the price at which it's able to raise debt capital, because it is trading and offering equity as a future trade-off. Infrastructure and project-related debt. This is now moving from looking at what do I have now, how am I performing now, to what kind of potential do I have in the future. If we put in place a toll road between here and where's the very high volume Kitengela, you could from here turn left and go straight, no bumps, no lights, straight to Kitengela. You pay for that. Now there's no road there, but based on the potential revenue from that kind of a road, you're able to package a deal and say, I will put in place this infrastructure. It will have, based on the number of cars in Nairobi, the amount of traffic that goes into Kitengela, I know I'll be able to get X amount of revenue year on year. Lend me the money now to put it in place, so that when the revenue comes, I can pay you back. That's project-based funding. And it really can now be much more catalytic in unlocking potential for rolling out projects, because it's not about what I have, it's the potential of what can be put in place. But there must be very clear projections, there must be very clear accountability for there to be confidence. And then the most complex level of that is securitization, where you're saying, I am, for example, health. I know that currently I have X number of billion shillings out in student loans, which I'm committed to get. Everyone is under a legal obligation to give me that money back. So it's a performing asset. But I only have so much money as help. How about I take all my existing loans, sell them off to someone else? I have 9 billion in loans, I'll sell them to you for 8.5 billion. I get 8.5 billion cash today. As help, I can start issuing more loans. They're the ones who will now manage the existing performing loans and collect them in. As help, I've sold them. So I don't get to wake up tomorrow and say, hey, by the way, I want those loans back. They're gone. But everyone now who is lending to that fund can lend on the confidence of their X number of loans with this kind of performance potential, and I know my payments are going to come out. So you're moving, it's called off-balance sheet financing. You're moving it from the original potential borrower to another entity, an SPV, whose sole purpose, much like the rate, is to hold assets, make sure payments coming in are collected and distributed accordingly. And that's where the positive cycle of money can come in. And we stop having all these assets that have the potential to give us money, but we're broke right now. You know, the amount of graduates we're having year on year in Kenya, help can't keep up. And help will say, government, give me more money. But if they said, no, let's take our assets and make them work for us. Sell them off, get more cash, start lending more money. Lending is a revenue generator. You start getting money flowing around. Now, I pretty much explained each of these, but I think slides will be made available, but it's just giving you a bit more detail on the differences and potential in each one of these to make sure that there are alternatives for us to engage, to participate, to enjoy the benefits. Now, once again, this is just an indication of the kinds of structures you need for securitization. And this is why it's much more complex, because of the number of parties that are involved. You don't wake up today and say, I have an oil book. I know it will make me money, so I can just buy it and enjoy the revenues that will come from that money. Okay. Who has ascertained there's actual oil? How will I know where that oil is going to come from, where it will go, where the revenue is going to come from? So you need a lot of intermediaries involved in making sure that there's confidence. You need credit rating agencies who are telling you what is the credit potential of what you're borrowing against. You have quality control firms who are, for oil, the ones really ensuring that the right kind of oil is being pumped, distributed, the right cycle is moving. You're having servicers who are collecting the money, distributing, trustees, lawyers, collateral providers. So you don't securitize 10 bob. It's the costs. But once you start looking at scale, then you can absorb these costs and deliver value. Those are the opportunities in the region. Now, this is just international demand. It's to remind us all of the fact that you may read the press and think Kenya is broken. Kenya has problems. Kenya just has politics. Kenya has potential for Ebola. Kenya, tuko na shida. The world looking at Kenya is seeing such a good investment risk that when we went to international markets to borrow, 4 times the amount of money we wanted to raise was thrown at Kenya. We want to invest in Kenya for the next 5 to 10 years. That's what the Eurobond means. It may sound all sovereign bond, what's this thing, what's its relevance? That told us how is the world perceiving our country as a destination. And the world told us very well. So don't delude yourselves that because we have problems, let's just wait. Maybe next year things will be better, then we can invest in Kenya. The rest of the world is investing in Kenya, and Kenya might be swept right out from under your feet. So there's no problem with money. There's a lot of money flowing around the world, and it's looking for places for return. Kenya is giving good return. Kenya has, notwithstanding what we report in our own press, has clear institutions, has strong accountability. So we're a good investment. So we as Kenyans need to make sure we're jumping on that bandwagon and not being left behind. But that will only happen if we address this issue, highlighted in green, domestic saving levels. Now, we always like to compare ourselves with EAC, Kenya, we're moving, we have potential, we're good. The minute you compare Kenya against our real competitors, the rest of the EAC really genuinely isn't Kenya's competitor. They don't have comparable GDP figures, size, potential. We compare ourselves with real competitors. Vietnam's, Morocco's of this world. Compare our savings rates. This is why these countries are able to grow exponentially year on year. Because there's money available to fund. There's money available to circulate and go back into long-term investment. We don't raise our savings rates in this country. And savings is not the money you put in your savings account in the bank. That's just a portion. It is the amounts you commit to insurance. It's the amounts you commit to pension. Because those are long-term pools of money that sit there that can then be channeled and redirected. There's a lot of concern about the growth of NSSF, the higher rates we're going to have to put into NSSF. Subject to improving governance at NSSF, that is what's going to help Kenya. Because it will significantly grow the amount of money that's available for investment in long-term economic activity in the country, which can allow us to grow. Money follows money. As an investor sitting in New York, I'll look at Kenya and say, okay, well, there seem to be projects, but who is investing in them? If you show NSSF and the other national pension funds have already put in the first 20%, they're like, wow, if the long-term investors in that country think it's a good risk, the money flows. So we need to create that positive pull for money to come into our country. That's the rather long rather than short of it. Happy to take this.
Questions? Wow. We are ready to come in questions.
Thank you so much. Hello? Thank you so much for the very informative presentation. I have a couple of questions. What is the entry level to invest in a REIT as an individual investor? And I have a question on the returns. From the concept you've given us of a REIT, I've just basically compared it with a mutual fund. I don't know if I'm correct in that. Like a mutual fund for equities and for, yeah, from mutual, let's say, yeah. So I've done a mutual fund and I've really not been impressed with the returns that I've gotten. So what are the returns that you get from a REIT, and are they really competitive?
Can I answer one at a time?
Yes, yes.
Small break. Now, first question, what is the entry level? The entry level will be determined by the rate products that are put on the market. You see, as a fund manager, they'll decide that we're building a rate pool. We're trying to raise, let's say, 500 million, and we are willing to raise that 500 million in increments of 5,000, 10,000, 50,000, 100,000. So there is no minimum. It will be the structures of the product that will determine what size they want to do. Now, when you look historically at, for example, CIS, Collective Investment Mutual Funds in Kenya, they came in at minimum investment of 500,000. And everyone said, these collective funds are for rich people, they're not for us. The reason they were doing that was they had serious challenges around how to manage numbers. But with technology, what IHUB is putting out into the world, technology has made dealing with people neither here nor there. The amount of effort you need to put into one client versus 10,000 clients is the same. So you have had unit trust minimum investments have gone from 500,000 to 5,000 shillings in Kenya as exists today. So there is no absolute minimum. It will be determined by the fund managers who put out the product.
Can a poor man do a REIT?
They can invest in a REIT. I don't think a poor man should structure a REIT, but they should definitely invest in a REIT and get that return. And I think that's the important thing. It is not what you should focus on is what you own, which is a unit. Whether you are the person who brought a REIT into existence or not is neither here nor there. It's, are you able to benefit from the returns on the pool? And that you can get as a unit holder, which could technically even start 1,000 bob, 100 bob, depending on how it's structured. Now, the other side of that question is, what's the return potential? Out of interest, when did you invest in your mutual fund? Which year?
That's the reason. What's the use of 50%?
2 years ago. Now, 2 years ago, that was around 2012. And it has not returned.
I'm not impressed.
Okay, what return are you expecting? Let me put it this way. When you look at global mutual fund returns, they're looking at depending, okay, if you're looking at a debt, something that's made up of money market and debt instruments, you're looking at maybe 4 to 6%. If you're looking at a mixed pool of equity and debt, you're looking at about maybe 6 to 10. If you're looking at pure equity, you're looking at about 11 to 13, 14. Those are good performing. Those are global rates. The question is, what is your pool that you invest in? If you invest in a fixed income bond fund,
Low risk.
low risk, you get low return. If you invest in a mixed fund, middle risk, middle return, high risk, higher return. When we had IPOs in this country, and you were investing day 1 at 9 bob, and day 4 you got up 24. That is not natural. We gained a belief in Kenya that going to the capital market is a way to make very fast money, very easy. It's not sustainable. You want to be investing, if you're investing in capital markets, you want to be putting money in day 1 and looking at a 5 to 7 year window on the return on that money. Safaricom. You put the money in day 1, everyone tried to sell on day 2. What happens when you have oversupply? Prices crash. And we all said, we've been lied to. No, you put too many shares into the market. 7 years later, 250% return on your investment. That is the nature of capital markets.
Ordinarily, and I look at you are young, the younger you are, the higher the risk you take. When you get to my age, you look at the lowest risk. So right now, just put it in the equity, everything. Okay.
But you see, because why I'm asking that is, between 2012 and today, the exchange has returned, I'd say, approximately 57% return. No market in the world has delivered a 57% return in 2 years. So if you're not happy with 57%, one, either you need to ask your broker, your fund manager, what is their pool? That maybe they're invested in the wrong pool, that you're not enjoying that kind of return. Or you need to rethink what your expectations are.
You can't mix land in Kitengela and this, because the land will give you 2,000%, which is unusual, isn't it?
And it's not, that's not how we're going to build our country. With the current cost of land, the potential for economic development is going in the opposite direction. If we all want to own a home one day, but we all want to sell our plot of land for 2,000% return, that 2,000% is translated into the cost of your house, because it's what's going to be built on there and sold back to you. So until we bring a bit more sanity into land management, and that's what rates are going to be able to do, because you're able to buy large chunks of land, develop them, and then focus on the return on the development, not the speculation on the land, which has not really changed in value. That is what's going to open up our potential.
There's another one there.
Thank you. First, Muthaura, thank you very much for a very enlightening presentation. And you gave it in such a user-friendly manner that somebody with a simple mind like me, at least I could understand, and thank you very much. Now, there was a diagram which you had on the screen, where you had in the middle the REIT, and then you had the REIT promoter, the REIT manager, and the trustee. Reading in the newspapers, I've seen that you've approved a number of REIT managers, about 4 or 5, and trustees also about 4 or 5. I've not seen any approvals for promoters. So the first question is why? The second question is, are there a number of applications for promoters in the pipeline? And the third question is, if a potential promoter applies like today, how long is the process before they get the approval? Thank you.
Thank you very much for that question. First and foremost, in this structure, the only people who are licensed and regulated are the rate manager and the trustee. A promoter is the person who comes up with the end. A promoter often is either the person with the project or the person with a number of properties looking at how to manage it. You need no approvals to be a promoter. But as a promoter, you have a responsibility to bring in the professionals, the rate manager, the trustees, and now all the other service providers to operate a trust, a rate instrument. So that's why you'll never hear about any kind of approval for a promoter. It's not an approved job. So we currently have 6 rate managers who are licensed and 2 going on 3 trustees already in the market. Now, one of the reasons why you have not seen any rate instruments being issued, and I'll be very transparent here, is some of the structures that are going to make this tax efficient, the rules under tax that need to be there to make sure that money, when these properties move into here, you don't pay stamp duty. When money comes from the investors, from the unit holders into the rate for transmission back to the investors, so when the money, for example, comes from the properties into the rate, that's rent, for distribution to you as the investor, to make sure you don't pay more tax here. That is what we're still working on with the Revenue Authority. We're at a very advanced stage. And once that is clarified, then everyone will be able to roll out their product. So it's the tax treatment that has made people concerned that I currently have 10 buildings in Nairobi. I want to pull them into here. But it makes no sense for me just by virtue of putting them into a rate, I've incurred 4% per building. Because that moving them has no purpose other than as a mechanism to structure and create revenue.
Whom do you see if I am a chairman of a chama? Whom do I go to get me into this?
You will go to, now chama, you have buildings or you want to invest?
You want to invest in.
You go see the rate manager. Yeah. The rate manager will be able to tell you what are the different products available, what are the different pools, so that you can now walk through what kind of revenue return are you looking for, and they can guide you.
We will come forward this way. Next. We will give everybody a chance.
Thank you very much, Paul. I hope we get this presentation. Yeah. So I'm not the investor. I'm assuming that the investor will be a Kenyan. But if we are approved and our main investor was foreign, my experience has been that foreign investors investing in our country have, as a rule, wanted some kind of sovereign guarantee for their money. Now, what you have showed us is that actually what you need is some kind of trust that revenue generating will be able to pay the investor. How does that square up? Out with a foreign investor who might need over and above guarantee some form of sovereign guarantee from the investor.
I think, perfect question. When a foreign investor is dealing with, for example, a power project in Kenya, they come in, they're going to build, basically they're going to build 100 megawatt plant, and so I want to put money into that. I'm talking to Kenjan, and I don't know whether tomorrow Kenjan will change leadership, will decide to change its tariffs, or will decide instead of distributing money, it will apply it to another fund. So I want a sovereign guarantee. As I come to this country, I am not looking at Kenjan, I'm looking at government. That's why sovereign guarantees are always being asked for. What happens when you put in a rate structure is the investor is looking at the rate manager and the trustee, because those are the ones that give the confidence. They're not looking at the person, the promoter, who originally had the property. They are looking at licensed and supervised professionals based on very detailed financial information, very clear projections, so you know what's going to happen, where the money is going to go, and there's very clear legal liability. So the need for those sovereign guarantees are removed, because you're no longer dealing with a government or government-related entity. The assets have been moved into what's called a bankruptcy remote special purpose vehicle. It has no other purpose other than to own assets, collecting revenues, distribute revenues, and it carries no other liability. If you're dealing with government, government has many liabilities. And tomorrow they'll wake up and go, hey, we wanted to distribute that money, but there's a doctor's strike. Let us not pay that one today. Let's pay the doctors and then we'll come back to you. That's why you need sovereign guarantees, to carry that kind of risk. But once you transfer assets into special purpose vehicles, that risk disappears. Because the clear legal liability is placed in a single entity with clear legal obligations.
That's not in place.
Yes, that's in place. That's in place.
Thank you, Muthaura. You've talked about securitization and the short-term horizon of banks, and also the fact that they're using short-term money to fund long-term mortgages. Do you envisage that REITs will help solve that issue in that, I guess, structural issue with our mortgage sector?
Yes and no. Now, REITs globally, it is possible to take a REIT and securitize a REIT, meaning you take a REIT and the revenue being received by a REIT, and then you bundle it together and sell it on once again. And that's how you get, for example, the securitization of mortgage-related REITs. That is a slightly more complicated structure. And what you'll find is, as we stand as a country right now, we have banks who have mortgages. And many of them don't have that many mortgages, so they don't have a lot of balance sheet pressure. But you imagine, for example, a bank has, let's say, 10,000 mortgages. So it knows the payments it's going to get over the next 10 to 15, 20 years. But it has no more money to lend out new mortgage money. The securitization will allow them to take those mortgages, sell them into the special purpose vehicle, the SPV, which can then raise money from investors, give the bank more money to on-lend, and then now the investors just look to the SPV and the other structures for performance. So that is what will unlock a lot of the pressures in our mortgage market. But first and foremost, we need to address the cost of debt in the country. As long as our mortgages are 14%, there won't be that many mortgages. That's going to come from the government putting a lot more pressure on its T-bill and T-bond rates. As long as government is borrowing at 8 to 12%, every other entity must borrow above that. Because a government can print money. Governments are sovereign borrowers, it's almost guaranteed to get your money back. So everyone else in an economy borrows at government plus a margin for the risk of you being more risky than government. So you have to bring down the sovereign borrowing rate. Big steps on that, were, for example, the Eurobond, so that you take Before the Eurobond, government borrowing rate was about 8.9%. With the sovereign bond, they brought that down to about average of 6.5%. So now it gives us a benchmark as against which we can borrow in future at lower rates and therefore create more room for corporates to be able to borrow. And once the corporate rate is lower, then also the personal borrowing rate can once again come down. So it's a wider issue, but securitization will help in the longer term.
Thank you for a great presentation. What's the role of rates in bringing up a lot more housing for the low cost? That's a sector that is not catered for, and we have a glut at the top level. So what's happening? And there are incentives that are in place to make them more attractive.
This for us was one of the most important potential impacts of real estate investment trusts. That when you're dealing in small scale projects, you want to make the maximum return from each unit. Hence why all that is coming up is high value office buildings and high end residential properties in Kenya. Because per unit return is very high, because your financing costs from the banks is very high. So you need to make those margins. If you're able to structure rates, so you're able to do much larger projects at much lower costs, then the need to have as high a per unit return comes down. And then it becomes cost effective to start building low income housing. But low income housing will always have to be large low income housing. Working with entities like NHC, working with entities like NSSF, we're able to do scale projects so that the per unit cost can come down, become more accessible, and still be commercially viable for them as a developer.
Thanks for a great presentation. We've seen this is now, we're at the point where real estate and securities are coming together. How at risk are we from what happens in America's mortgage crisis, and how do you protect ourselves?
I think for us, it's an interesting challenge. The first time we tried to introduce securitization in Kenya was in the beginning of 2008, when the tremors of Lehman's were just starting. So by the time people were now, okay, securitization, maybe it's something we want to do, the world had decided securitization is the worst thing you can ever do. It's evil. People will lose money. But you need to look at what was being securitized in the US. What caused the collapse was what I think was like someone described as ninja borrowers.
Subprime mortgage.
You have, exactly, subprime. It is, you have a person who has no potential to service the mortgage, being allowed to borrow on the presumption that you don't care if they pay you back, because all you do is sell the house, whose value is always going up, and move. But you get enough of those people coming into the market becomes overheated because everyone is only buying houses to flip them. So at some point, prices will either have to stabilize or come down. Bubbles burst. It gets too hot. Bubbles burst. When it comes down, you realize that you have lent to someone who has no money. They were called ninjas because they had no income, no job. And still they had a mortgage. In Kenya, anyone who has tried to get a mortgage, my God, your capacity to pay that mortgage is vetted 6 ways to Sunday. So there's no subprime potential in our country. The reason the US got there was banks realized that all the middle income people had a mortgage. So they had no one else to lend to. And they had all these state agencies who existed solely to guarantee their lendings. So they said, let's stop being so credit conscious and open ourselves up to all these people who haven't been able to access so that we can create revenue. We can lend it out. It's guaranteed by Freddie Mac, Jimmy May, those entities, and it will be securitized and sold off. So you don't care about who you're lending to, because literally, they found, you go into a bank, they had a machine that was built to sign the bank manager's signature. So all you do is run forms through it. It signs and approves. You don't even read them, because all you're doing is collecting it, so you can sell them off, collect the revenue from the seller, and lend again. We have, one, a risk of us as a country. Two, we only lend to people who can service, so our securitization will be very sound, very stable, no risk.
Good afternoon. If you could please just go back to the typical REIT structure slide. Could you please clarify a bit more on the tax, the discussion on tax? Initially you had said that if properties are being put into the REIT, then you don't pay the 4%, but then thereafter you said that there's a 4% that you'll be paying. I got a bit confused there. Could you please just, I know you said it's under discussion, it's probably confidential, I don't know, but please just clarify that, because that would be a very important component for somebody who's planning to put in property into a REIT. Your ability to get your tax exemptions or waivers. Then secondly, you had talked about that there are several registered, about 6 REIT managers, and probably 2 going to 3 trustees. Where would I get that information if I wanted to Google and get that information? Where would I get it? Then the third one is the promoter. The promoter is the one who owns the properties. And you said that the promoter would need to get in touch with the REIT manager and a trustee and structure this REIT so that their properties can now go in and start generating income. That sounds almost it sounds very simple. Is it really as simple as that? If you're talking about this person who has 20 acres in Kitengela, step by step, what would this person need to do? Would they need to hire a lawyer, you know what I mean? If you could please just help demystify it, because many times the issue is how to start. You may have all the information, but you don't quite know the first step to start getting there. Thank you.
I will answer your questions starting with the middle one, and then go from there. How do you find out who are approved REIT managers and trustees? Go to the authority's website, www.cma.or.ke. It will tell you at any time who are the licensees of the authority, their contact details, and the fact that they're licensed. So that's how you know who these people are. It's not Googling, go to our website. We have a primary responsibility for one, establishing they're competent, that they're fit and proper, and continuous supervision of them, that whatever they do unto you, they will be supervised in the manner in which they do it. So the authority provides that information. Now, the next is on the tax treatment. Now, I will explain to you what is the tax treatment we are seeking to get. That if all the detail of what we're proposing is delivered, this is what will happen. You will be able to take a pool of properties, and if a rate is established in line with the relevant capital markets rules and regulations and structures, and has in place a licensed rate manager, a licensed trustee, and has all other necessary approvals, you will be entitled to move properties into the entity, which is in effect registering them in the name of the trustee without paying stamp duty on that transfer. The reason being, the transfer of those properties has no commercial value. other than to establish a REIT. And therefore, no stamp duty should be payable. You're merely moving it from holding it in the names of 10 different individuals into the name of one individual. There's no commercial intention in that, so there should be no stamp duty. Once the properties are within the rate, and the rate now uses those properties as the basis to borrow money from the market, saying we have a pool of assets here that will be performing, give us money. When unit holders bring money into the trust, and where these properties, which are now in the name of the trustee, produce rental income. When that rental income is passed on to the REIT manager for distribution, once again, that transfer of revenue has no commercial purpose other than for ease of distribution. So money in the hands of the REIT will not be taxable, because all it is pooling it. Once the money is pooled and it's moved back to the investors, it will only be taxed in the final hands, in the ultimate beneficial holder. So once you receive money as income, it's taxed like any other income tax. But you will not be subjected to a double taxation level because money passed through another entity.
Sorry to interrupt. So what I hear is that the properties could belong to various individuals or various entities, and they come together, they have some form of an agreement between them, and then they place those properties in the name of, they have been transferred in the name of the trustee. So that's one. Maybe you could just clarify, confirm that is the case. Then secondly, for those properties to be placed in the hand of the trustees, the instrument I believe that would be in place would be some form of a trust. Yes? Again, correct me if I'm wrong. Now, from experience, there's always been issues, for example, at the land registry, where the trusts will need to be registered, where registration of such trusts takes years. So even as you're having your discussion on tax, is that a discussion that's being had? Otherwise, all else is really, yes.
Thank you for the questions. I think they're very important clarifications. Now, on the first point of whether the properties can be in multiple names, yes. But the transfer must be for the sole purpose of the establishment of a real estate investment trust. You can't be pooling assets because you want to sell to so-and-so and then call it a REIT. It must be part of a clearly legally documented structure for the sole purpose of bringing properties together for purposes of issuing units to raise money to buy, for the REIT to buy those from you. So that the structures must be very clear, very documented. But insofar as it is clearly in line with the transfer for purposes of establishing a REIT, in line with the law, it can be multiple names. Now, the next level is whether the trustee. Now, if you're establishing a trustee, they have what is known as the Trustee Perpetual Succession Act, which is the instrument through which you move a trust from being in the name of individual trustees to making the trust a corporate structure, which is the registration that takes years, as you have mentioned. Now, part of the process of designing this REIT infrastructure was extensive engagement with Ministry of Lands and the AGs around the necessary processes for registration of trustees for purposes of a REIT. So that was a core part of this, because it was recognized that unless trustee perpetual succession registrations are happening in a timely, efficient, and transparent manner, no REIT will happen. So that was factored in.
Thanks for your presentation. My question actually is on real estate regarding individual ownership, or because actually on ground what we see is a group of individual investors in real estate. And when you have like background, somebody will tell you that we can invest on this on real estate, you have some percentage on it. So my question is, what will you really advise on that? Because that is actually what we see on ground, and some of us might be victim of it. So, and you really advise on, because what you also say, you don't fund the individual real estate when you really need it. So thanks.
Part of the reason for coming up with the rate structure was to bring a bit more certainty and transparency in how money is being collected for real estate investment. That if someone comes along, meets you on a road with a flyer and says, we are looking to build assets, build an estate, give us your money, we'll build it and give you a return. That arrangement is very hard to manage. It's very hard to know whether that person is legitimate. It's very hard if they don't pay you, other than through the courts, police, and other structures, to make sure you get your money back. So that is why the rate is coming with a bit more rigid structures. You must have a rate manager, must have a trustee, because those are independent people who are supervised, who are accountable. When they ask you for their money, for your money, it needs to be on the basis of clear legal documentation, which deals with liabilities, consequences, all of that, so that you have transparency. Now, I can't tell you never invest with a person who is not doing a REIT. But I can tell you, if you invest in a REIT, you can be a lot more confident about the potential of that investment than others. And that's what we're trying to make sure.
We'll take like follow yourself and the back. Yes, then we can have some. Yes, three, then we can have some.
Okay, I'll start off with a quick poll. How many people here actually have CDSE accounts? Was that less than 10?
No.
Almost 200 people?
I can see.
Yeah, there's more at the back.
Yeah.
Anyway, my question actually is to CMA. Muthaura, it's well and good that you're building this new instruments, you're making changes with the NSE, and we hear it's going to be possible to get in and out within the same day and get back in on the same shilling, which is going to be about 30 times faster than it is today. What exactly?
Not that,
4 times?
Let's be clear. T plus 4 is the current settlement cycle.
Yes, it's T plus 4. Yes. And then if you're to do a full cycle back to a shilling, it's another T plus 4.
No checks are clearing in 1 day now. So T plus 5.
Okay.
Let's be clear. Okay,
T plus 5. Nevertheless, what are you doing to make it easy for retail investors, such as myself, with 10,000 shillings, would like to get into the market, to make it as easy as possible to get in and out? Because, to illustrate, it's taken me 7 weeks to get a change on my email, to change the email address on my CDSE account, and it's still not done yet. So, is it build it and they will come, or are you doing certain things to make it a lot easier for people like me and the 10,000 shilling poor people that apparently shouldn't be promoting but should be investing in rates to get in and out?
Firstly, if it's taken 7 weeks to change your email account, that entity is under very clear obligations on conduct of business and its management of its operations. Complain to us, we'll fix it. 1. 2, when you look at how many people have CDS accounts, I think that's an important statement, because we are not telling, CDS accounts are the tool through which you as an individual invest directly into a share in the market. If you compare the South African market and the Kenyan market, South Africa is close to about 70 times our size as a market. They have a little over 100,000 CDS accounts. We have 2 million. The difference is, in their market, people invest through collective investment schemes.
So you're not going directly into the market. You're not dealing with settlement cycles. You are dealing with a fund manager who has a responsibility to have adequate funds and securities available at any given day, that if you want to liquidate your CIS, it is done. End of day, they establish net asset value, and they're able to pay you. So it takes out a lot of the intermediation that you otherwise need to do to get into the market. So we're trying to encourage people to move away from direct. Don't take your 10,000 bob and find a share in one company which you can buy 300 shares in. Take your 10,000 bob, put it into a collective investment scheme. One, it will be better managed. Arguably, maybe you're a financial guru. Arguably, it will be better managed. And when you need to exit and enter, exit and entry will be a lot clearer. So these products are to address the exact problem you're raising. How do we reduce the challenges and barriers to access to the market that people are facing right now?
Okay, next one there. We can take two now. I can there, and then you pass it to.
Okay, my question is from a real novice. Today I've enjoyed the presentation, and I've learned a lot of terms I didn't know. So I'm asking this from a novice point of view. I have read about REITs for some time, and I'm thinking it's a good idea. But what I think I understand is you need to have a REIT company. You need to be several of you, maybe convince your friends or other professionals around you. And I'm thinking there are companies that do invest in real estate. Like you can invest in them, and then they will invest in real estate. What advice, or if you compare going direct to REITs where I have to convince some people, then I don't know the risk involved.
Do you belong to a chama?
Not yet.
Do you know anybody who belongs to a chama?
Yeah.
Do you know anybody who belongs to a chama?
I don't mind, but what if I'm giving this idea to a chama, my chama, let's say I'm in a chama, and I'm trying to convince my chama that we need to invest in a REITs company, maybe that car park company. If you compare going to the more less riskier way with going investing in REITs, what advice would you give?
Okay, like what I told her that since she is young, she can take higher risk and low risk.
Yeah.
The returns are different, and that is maybe can advise you on that.
I think first and foremost, you have said going direct to an individual who claims they're doing a real estate investment and giving them money is lower risk than going to a rate manager who has a legal responsibility to, one, identify how much money that you've collected from you, their timelines for paying you back, and their legal obligation to make sure you receive that money. You've said this is less risky than this. Do you still, after that description, still believe that going direct to this individual is less risky than the rate?
But I think that's what I think. I think going to that person is less risky.
Why? Yeah? Maybe I need to understand why.
Why I think is less risky is because first, I'm not a professional in real estate, and maybe even in our chama, there's no one who is a professional in real estate. And going to this person, he understands the current infrastructure and what's happening. Okay, that's where I think it's less riskier to go through a person.
Thank you for that. Now, in reality, when someone comes up to you and says, I am a developer, I know this market, give me money, I will invest it for you. On a very practical level, you have no way of establishing, one, that they are a developer, two, what their track record is for developing properties, and three, that if you give them money, if you need it back, how you will do it. You can't with that individual. The very purpose of a real estate investment trust or REIT is when you go to an established REIT fund, one, it must have a duly qualified and registered property manager who is overseen by the Institute of Surveyors, Institute of Architects. It must have a project manager who is responsible for, he carries appropriate licenses and approvals as managing development projects. You have the person who will receive your money is a fund manager who has a license and is supervised to make sure, one, they are competent to receive your money, and two, if they don't pay you back, there will be direct consequences. So the structures are actually what give you comfort, confidence, and protection. Where there are no structures, you're taking a chance.
Okay, now let's take the question here. Last one.
Thank you again for the presentation. What I think is kind of unclear right now, I mean, there was a great part in the presentation about debt and equity and diversification, and I personally understand what your point is, but I think what's not been communicated so far is that it's intended to be an equity investment. You're not supposed to go out. I know here are a lot of entrepreneurs in the room who want to go out and do this themselves, but this is not how the product seems to be intended to be. It's basically, if you ask yourself, what am I doing with my money? Am I putting it in a bank account, or do I want it to have a return? So it's basically an equity investment because you're taking partial ownership in return for profits, but you're not going out and founding a REIT. And the REIT in itself is so appealing. Maybe we should go away from calling it REIT because it's real investments, and real investment is rather secure as opposed to other investments. So your money is kind of protected because you're investing in relevant infrastructure products or commercial real estate, which is highly requested in this market. I mean, getting a mall, renting out a shop to someone is very high security as opposed to, I don't know, gambling in the stock market on personally going out and buying a single share. And by combining with a lot of investors, you basically get more money to do more, and this larger amount of money, like, it doesn't have to be 5 people what this over there sounds, it's basically thousands and 10,000 of people that give little amounts, and so for giving this amount and combining it, you get to invest in those real nice pieces of investments like a pipeline. A pipeline has very low risk because it's liquid. As the oil is discovered, you basically oil, everybody needs oil, you get to participate, and then you get, by combining your investment, you get a relative secure return from this investment. And I think this is what it is about, and not about founding a REIT. And I mean, there's a lot of entrepreneurial spirit in the room, but this is not the intention of this presentation. It's a good investment for you to personally grow your income without letting it rest in some bank account and not earning any return. And this is a rather secure opportunity to invest in great investment opportunities across this nation as combined as a group.
Thank you. I'd like to welcome you on all my future presentation events. To put things in context, I think that clarity is very important. That in presenting this product, we're presenting investment and savings opportunity. We're not presenting a model. We want you to invest in REITs so that we're able to raise larger pools of investment for investing in these very significant projects across the country, as well as larger scale types of projects. So that's where there's a distinction. And maybe just to qualify that, when you look at REIT investment, there are two kinds of REITs. There's a development REIT and an income REIT. A development REIT where you're putting money in to invest in a construction, and then you're hoping to get returns from the capital gains and from onward disposal of that property. That is more like an equity investment. When you have an income REIT, which is you're investing in a pool of income generating properties. Rent is coming month on month, every 3 months, very clearly. That is more like a debt instrument, fixed income, because you know every quarter, year, you will receive X amount percentage. So it's much more stable. So even when you're choosing what kind of investment you want, if you're looking for high risk real estate investment, you go on the development side. If you want stable, continuous returns, you go on the income generating side. So that's the decision.
Can we clap for Paul? I'm going to request Matt to come for just 2 minutes, because Matt is the one who presented first, for those of you who came late. Briefly, very briefly, in 2 minutes you say what you said and any other comment for our African Union visitors who have come in. Then we will have Sam to actually summarize everything. So even if you came late, you will get the gist of our discussions here today. So Matt, you can. Because I'm going to go sit, maybe you stand up and introduce you. So as soon as Matt leaves, then this is my former colleague, Sam Wale, who was working in the office of the president, one of the senior most staff in the office of the president. Now he's doing consultancy. He's going to summarize this and make a few comments after Matt has spoken. What is the technical people? Technical. Where did they disappear? Yeah, here. It's not working.
Oh no, just to change the thing, but it's this one instead of this one. But no, so this one and this is the one with my computer, so we have to select a different. No, I can do that. Okay, sorry for that. Thank you for your patience. I'm Matt Perlow, and I work with a company called IDEV International. IDEV is a financial advisory and management strategy consulting firm for small and medium-sized businesses in emerging markets. We have an East Africa office based out of Nairobi, and we also work in South America and the United States with our corporate headquarters in San Francisco. And I want to talk to you very briefly about investor readiness for entrepreneurs. What do you have to consider as someone who owns a business when you're thinking about taking on external financing? So firstly, you need to think about the uniqueness of your business and the value proposition that you can offer potential investors. Also, you need to think about barriers to entry, and this is related. If you start a successful company, what's preventing other businesses, other copycats from arising and doing the exact same thing that you are? Essentially, do you have a defensive market position? Also, you need to consider scalability, how you can grow your business and realize economies of scale, efficiencies, and the stage of business that you're at. Are you a seed business? Are you pre-revenue? Are you post-revenue? Are you growth stage? These are all really important factors. Additionally, when you're thinking about how to structure investment, you need to think about if you're taking on a debt investment, for example, your ability to service interest payments. Do you have the cash flow to be able to do that? Or, if you're going to sell an equity stake in your business, are you comfortable with giving away ownership? And if so, how much? And then finally, legal structure. If you're a nonprofit, for instance, there might be certain regulations surrounding which types of shares you can issue and what financing you can access. So this is a chart related to stage, and you see on the y-axis you have a level of risk associated with your business, and then on the x-axis along the bottom you see the different stages: seed, startup, initial growth, and expansion. And these are all different types of financing. This isn't comprehensive, but a number of different types of financing that you can access at those different stages of your business and the associated risk levels out there. Okay. And another class of investors that you guys might not be familiar with is impact investors. So if your business has some sort of quantifiable or measurable social impact, you may be able to partner with an impact investor to get more favorable terms. For instance, impact investors often offer lower interest rates on debt investments and longer payback periods. This is in contrast to commercial investors who purely seek financial returns. They're more risk averse, and they're going to expect you to have a credit history and be able to provide collateral. But after you've decided which type of investor you want to approach, which class, you need to decide how you're going to structure your investment. And there are a number of different ways that you can do that. You can, traditionally, you can take equity or debt. Equity is selling a piece of ownership of your business, and you will have to distribute profits in proportion to the ownership stake that you're selling off for investment. Alternatively, debt, you don't give up any ownership, but you have a fixed payment that you're going to have to service, and that can be a burden and sometimes an extra risk, adding in a fixed cost. Alternatively, you have grant funding, which can be, as we discussed earlier when I gave this presentation for the first time, it can be relatively no strings attached, but also there are sort of hybrid grant models where a grant can be converted into equity at some point. And you also have hybrid securities, for instance, convertible debt, which would be like a normal debt instrument, but then the investor would have the option to convert that into equity ownership at some stage. And for that option, they may be willing to lend to you at a lower interest rate. So that is the benefit for the entrepreneur, and the benefit to the investor is that if they see discernible upside in the business, then they can convert to equity and participate in those profits. And so after you've decided how you're going to structure your investment, who you want to approach, you really need to consider whether or not you are fully prepared to approach an investor. And so what types of things are they going to be looking for? You definitely need to have a well-thought-out business plan, and ideally, if possible, audited financials to be able to present to them, because they're really going to pick all of this stuff apart. That's their job. It's in their best interest to make sure everything that you're writing down, everything that you're reporting is logical, accurate, well-formatted. This goes along with realistic projections as well. What do you think your business can achieve in the next 5 years? And how are you presenting that? Is that going to stand up to really intense scrutiny? So you can be optimistic, and you should be optimistic about yourself and your business, but at the same time, you need to be realistic. Also, if you're buying and selling a product, it's really good to be able to provide contracts. So on the supply side, do you have risk mitigation in terms of inputs? So do you have formal contracts with multiple different suppliers, ensuring that if price goes up for one particular input, you can maybe turn to another supplier and get it for cheaper? And then on alternatively, also, you need contracts with buyers, ideally, to show that there are people who are committed to purchasing your products in the long term, over a set time horizon. And then, if you decided that you're going to approach impact investors, it's really good to be able to, as I mentioned before, quantify your impact. So if you are working with 1,000 smallholder farmers, and you've increased their income by 10% over the last year, then that's the type of figure that's really going to be appealing, and it's something that you can use to substantiate, corroborate your impacts. So after you have all these things together, approaching an investor is it's important when you're approaching an investor to consider their preferences as well, just to be able to narrow down the pool of existing investors that might be interested. So you want to look at their geographical preferences. Are they active in East Africa? Do they have portfolio companies here? Also, do they invest in businesses in your sector and stage? These are all very primary criteria that you can use to screen out potential people you want to speak to. If you need $100,000, are they willing to come in at that size? Is that considered too little? Is that considered too much? Also, expected return. That's something else you need to consider. And that is my brief presentation on investor readiness, and I'm happy to answer any questions if you have any. What's that?
Thank you, I'm Rachel. I'm just wondering if it's okay. Yes.
Yeah, I can.
Thank you for the wonderful presentation, because we just come from another workshop with the Union, and we're talking about investment and funding. So it's really appropriate, and I'm happy that our leader brought us here, because it's really putting a lot of sense in so many questions. Yeah, thank you.
Thanks for that. Yeah, and if you have any more questions, feel free to talk to me afterwards or reach me.
Well, thank you, Matt. I think we give a hand clap to Matt. And to Paul as well for excellent presentations. And all the people who have asked extremely useful questions. People have asked for clarifications, some have contributed new ideas. And we also welcome the large delegation, I think, from African Union that has come in a bit late. Unfortunately, we will not have the time to repeat the other collective instruments presentation, because we've been here like 3 hours. Ndemo, I don't know. I think you just have to trust on my summary, and I hope that to capture what has been said. But the most important takeaway for me, and I hope it's the most important takeaway for those who have been here the whole morning until now, is that as much as we value the hustling culture, and Kenyans will know what I mean by that, really, in this entrepreneurship series, we could start thinking about structured enterprise. And I think Matt has just shown a path that most of you who are entrepreneurs here should start thinking about. And one of the things that we have to think of is that in our societies, many of which are low trust societies, we need to think about trusting other people and partnering with them. And that, I think, is a very important change in the mindset, that I can't do it all alone. I can travel a longer distance if I travel with other like-minded people than doing it by myself. And that then, if you're then able to get like-minded individuals, then I think you can be able to go down the path that the IDF has just proposed, and be able to think of how can you put together an enterprise that has the potential to survive the first 3 to 5 years and actually become part of Africa's wealth and employment creation. I think one of the other things that came out for me is, and in particular in Paul's excellent presentation, is about collective investment structures. And I think he spent quite a bit of time explaining to us how capital markets work, why they work, how it allows smaller retail investors like ourselves to diversify our investment portfolio, to have greater liquidity, to benefit from professional management, because most of these structures have properly, these schemes have proper management. Again, the benefit is tax efficiency, you spread your risks, and most of all, particularly in our present context in Kenya, it allows ordinary people to enter into big projects, national projects, and other opportunities that they would never have an opportunity to get into. But I think for me that is very, very important. And he spent even more time discussing the real estate investment trusts. He gave us all a website to go to that please, if you'd like to know more about the REITs, you can go to the Capital Markets Authority in Kenya website, and I think he'll get a chance to repeat the actual website address when we give him a minute or so to say something. And there, he gave a list of so many types of investments that people have never thought of as being potential rights investment. For example, offices, hotels, factories, warehouses, shopping malls, mines, parking lots, toll roads, plantations, and all kinds of things that normally we expect wealthy people to do, or international investors to come and do. And yet, if we were to get together into collective investment schemes, we could actually be part of that investment and part of that wealth creation system. He also described the structure of a right very clearly and talked about the trustees, of whom I think 2 are registered, managers, of whom 6 are registered. It was clear that we are considering the tax issues about it, and that other things like the promoters and the properties, those are things that are largely in the realm of those who would like to go in that direction. A number of questions were asked in terms of how do people enter into rights, who are the right managers in Kenya and trustees, what guarantees, if any, are provided for foreign investors, and also I would think that if I was to come to what I think we should take away, is that if, as Africa, as Kenya, we're thinking about long-term wealth and employment creation, we're thinking about equity, we're thinking about broad ownership in society, then I think we need to spend a lot more time thinking about these collective investment schemes. Also, it became very clear that you can actually actualize your personal goals in terms of investment and wealth by working with other people. You don't have to do it alone. It also became clear, at least to me, that really, unless we up our savings culture, that we really have a very long way to go, and that if I was to ask myself as an individual, what have I gained today? And if I was to ask maybe some few who have been with us throughout, what have I gained today? I would say that maybe, I hope that we take home a very different understanding of what entrepreneurship can be, what enterprise can be, and what are the benefits of coming together in terms of collective investment instruments. I'm also told that we will get the presentations. I think everybody who came in is going to get a copy of the presentations, and so those who missed will still have a chance to look at them. And I think both Paul and Matt seemed open to further discussions after this session, in terms of if you want to engage with them a bit more. I think you're open to engage with them. And I think Matt put up his email address so that anybody who would like to get in touch with him can do so. And I'm sure Paul, when we give him a minute or two to give us a last word, can also say something about how those Paul who came late can get in touch with you, what the real gist and thrust of your presentation was. So, the demo, I think I hope I've captured what you say.
Yeah.
And I want to invite Paul then to just summarize in case I missed anything, and then he can hand it over to you.
As Paul comes, let's clap for Sam.
Okay, thank you. Firstly, the authority's website is www.cma.or.ke. So a lot of the background information is available there. Very importantly, we have a glossary of key terms. So there's a lot of jargon I've used. Apologies for that. So there's a whole glossary of all the terms that are being used, what they mean, how to understand them. All our investor education materials on collection investment schemes, rates, investing in equity, debt, what it means to invest in the exchange is all available on there, as well as a lot of our research that we do in these areas just to help you. I've emailed the presentation to IHUB, info at IHUB, so that they can recirculate it more easily. And we're very available. Any questions, write to either corporate, C-O-R-P-R-A-T-E, corporate at cma.or.ke, or CE office at cma.or.ke. You can get all the information you want. All of that is also available on the website. We're at your disposal. We're in the public service. So any questions, we have a resource center within the authority. Our offices are in Upper Hill. Come in anytime. We compile a lot of the global research on the issues we're discussing. So if you need to do research, just come in. We will be very happy to help facilitate, answer any of your questions. Thank you very much.
For those who came late, this is a monthly forum where we meet to disseminate information, especially in the areas of opportunity in entrepreneurship. Last month, we delved into the oil services sector. Today, we have dealt with the REITs. Next month, and the date is going to be 27th September, you can put in your diary, we will be discussing value-added services in the agricultural sector. This is an area with a lot of opportunity, but many of our people don't know how to invest, where to invest. What we see is a lot of wastage that is going around, and we want to get experts to speak in this area so that the youth can understand the opportunities that lie in the value addition of the agricultural services in Africa. If you look at the performance in Africa, especially when you measure value-added services per person in Africa, we do very poorly, very poorly. Even if you compare ourselves with the BRICS, we are not doing very well. And so we will delve into that on 27th of September. And we will let you know which the topic will be for October. So there being no other issue, I want to thank all of you for coming. We want to thank those of you who have come from the African Union. We want to thank Chase Bank for being our supporters and being with us. And we thank everybody for coming, for taking your time to come and listen, and hopefully you can take something out of here, like Sam said, and you pass it on to somebody. Even long after we have left here, you can contact us through iHub and we can help. Even issues that we have already covered, we can go as far back as when we started, and we can work with you. All the services, all the speeches here are free, and it's just part of public service. It's called individual social responsibility. So if you feel you also want to come and speak, we will give you and align you with some of the main topics that we usually cover in this forum. So thank you very much, and we wish you all the best. Those of you who would want to say a word to Paul, he will be there. To Matt, they will be there. Otherwise, we are through. Thank you.
So thanks a lot, Dr. Ndemo, for sacrificing your time. And for the AU team, we're going to start your session at around 1:30. As I said before we started the session, if this is your first time to be at the iHub and you really want to know what goes around here, feel free to join in the session at around 1:30.